My dear students, welcome to my revision classes in advanced accounting. And today let us have a look on partnership business. My dear students, partnership is association of two or more persons who agree to do business jointly by making agreement. The agreement between the partners is known as partnership deed. The partnership deed is consisting of particulars like name of the partnership business, place of the business, nature of the business, and names of the partners, their addresses, capital contributed by them, interest and capital, how to share profits and losses, admission of partner, treatment of goodwill, and everything will be mentioned in partnership deed. My dear students, in the absence of partnership deed, the partners are not allowed to take any interest on capital. The profits or losses made by the business are to be distributed equally among the partners. Next point is, if any partner lends any amount to the business, so he has to take only 6% interest on that. That is about partnership deed. It is agreement. So the partnership forms are covered by Indian Partnership Act 1932. Then here you need to learn about fixed capital and fluctuating capital accounts. My dear students, the partners' capital accounts may be like fixed capitals or fluctuating capitals. Fixed capital means the capital at the beginning of the year, if maintained throughout the year the same amount till the end of the year. అంటే ఇయర్ బిగినింగ్లో ఏదైతే క్యాపిటల్ ఉందో అదే క్యాపిటల్ ఇయర్ ఎండింగ్ వరకు ఉందనుకోమా, దట్ క్యాపిటల్ ఈజ్ నోన్ యాజ్ ఫిక్స్డ్ క్యాపిటల్. ఇన్ కేస్ ద క్యాపిటల్స్ ఆర్ ఫిక్స్డ్, మై డియర్ స్టూడెంట్స్, we need to prepare partners current accounts to make all the adjustments, my dear students, like profit sharing and interest on capital, drawings for adjustment. We need to make one partner's current accounts. In case of fluctuating capital, my dear students, you can make all adjustments in capital accounts. Means here, my dear students, partners capital accounts may be fixed or fluctuating. This is a very, very, very important question you need to learn. Then revaluation account. Revaluation account is said to be, it's a nominal account. So this account is prepared at the time of admission of partner, retirement of partner, or death of the partner. All losses like decrease in the value of assets and increase in liabilities and new provisions created will be debited to this account. Appreciation in any asset value, decrease in liabilities, decrease in provision should be taken in the credit side. The profit or loss in this account is distributed to the old partners in old profit sharing ratio. That is very, very, very important, my dear students. Other than this, my dear students, you need to learn about sacrificing ratio. Sacrificing. So what is sacrificing? See, when a new partner is taken into the business at the time of admission of partner, the old partners are losing their share. For that purpose, we calculate sacrificing ratio, and in case of retirement of the partner, we calculate gaining ratio. So my dear students, from unit number 1, there is a choice of getting a problem in sacrificing ratio and gaining ratio, and in case of theory, fixed capital and fluctuating capital you are going to get, my dear students. So learning of theory in partnership may give 8 marks. 2 short answer questions, or if any long answer given, 12 marks you may get. So last year I have seen, my dear students, what is partnership deed, what are the contents of partnership deed. Such a easiest question they have given. Means when you prepared, you can write a lot. Then inka chudandamma, dissolution of the partnership business means the termination, means the winding up of the business permanently is known as dissolution of the business. When the partnership firm is dissolved, the assets of the business will be sold and liabilities will be paid off. For this purpose, we prepare a realization account. Realization, how much a asset realized, how much a liability realized. The profit or loss made in this realization will be distributed to all the partners in their profit sharing ratio. So after dissolution, my dear students, we have to study about Garner versus Murray case in case of insolvency of partner. My dear students, in case of insolvency of partner also, the partnership business will be dissolved, and whatever loss shown in a partnership realization account, that will be distributed to all the partners. In case of debit balance of insolvent partner, that is known as the personal loss of the insolvent person, that will be borne by the remaining partners in their profit share, in their capital ratios, not in profit sharing ratio. That we have to calculate capital ratio. We have to calculate capital ratio. In the capital ratio, they have to bond. Means the clear-cut distinction is there between the business loss and the loss of the insolvent partners. Personal account, that is known as deficit balance, that is to be borne by the solvent partners in their capital ratio, my dear students. Then one more thing is like treatment of goodwill at the time of admission of partner. You know, my dear students, a new partner will introduce some excess amount by way of goodwill. Either it may be in cash or sometimes goodwill may be created. When goodwill is bought into cash, my dear students, we have to write some entries like cash account data to goodwill account. When goodwill is distributed, goodwill account data to old partners capital accounts, my dear students, you know. Then when goodwill is withdrawn by the old partners capital account data to goodwill account, likewise. Or else goodwill can be created in the books. When goodwill is created in the books, there are some entries like goodwill account data to old partners capital accounts, likewise. See, when goodwill can be raised in the books or goodwill can be bought in cash, goodwill can be withdrawn by the partners, goodwill can be written off from the books. These are all the treatments. Then at the time of retirement of partner also, my dear students, we are not going to create any goodwill at the time. Whatever amount we are giving to the retiring partner, that will be borne by the remaining partner somehow. So this is all some theory questions in unit number 1 and unit